Good morning. It's Thursday, the 12th of September, and this is Govindraj, Ethiraj headquartered and broadcasting and streaming from Mumbai, India's financial capital. Before we start, here's some good news from our team. We are ranking 24th worldwide, or we are in the top 25 best business news podcasts, and this is chosen from millions of podcasts on Good Pods and ranked by listens, ratings, comments, subscriptions, and shares. So a very big thank you from all of us at the Core Report. And now the take. One swallow does not make a summer. Nevertheless, could the return of one or potentially two multinationals that we know of reflect the relative resilience of the Indian market and a small turning point or another turning point of sorts? The roughly $98 billion French retail giant Carrefour announced on Monday that they were returning to India with a fresh partnership after a decade of exiting the country. And yesterday it was Ford Motors which shut shop in India in 2021, which at that time left car owners panicking. Ford is apparently discussing buying its old plant and coming back, of course, for the third time. Now, India is not an easy market to do business with, as many companies have realized and learned the hard way. It takes years to figure out where the real addressable market lies for a product or service, and then designing the right approach to India's highly value-conscious consumers can take longer. There is no predicting, of course, that the markets will always grow. Take electric vehicles, the most logical product for a price-sensitive customer who has to shell out more than 100 rupees per litre of petrol. So electric two-wheelers and three-wheelers are selling well in India, but electric cars are slowing down because hybrid cars now seem more attractive and also, of course, allow car owners to hedge against a full electric car which has some limitations in terms of, for example, charging infrastructure or the fear of what the new cost of a battery will be. So Tesla, which seemed to be gung-ho about entering India, clearly found out it would only make sense to export cars into India and not set up a greenfield plant for cars that would clearly be beyond the reach of the average customer. That's right now. Of course, that could change. But hold on to that point, at least till the end. But everything, like I said, has context. After Donald Trump came to power in 2016, America started making it difficult for Chinese imports, and then companies started looking at moving manufacturing to countries like India. But India too has its own problems with China, particularly at the border, which also has flowed into trade matters. But global multinationals who are retreating to their primary markets are likely discovering that their own markets are not growing as much or are limited, particularly as the post-pandemic surge in spending that we saw world over is now ebbing. China is once again a big factor because Chinese demand is not recovering even as the country continues to reel from the fallout of the housing crisis. Demand is weakening, also being one key reason why global oil prices are sliding right now. So if countries can't sell more to China from within or from outside, that's a major growth market that's going off the table. Other countries like Russia are not in the reckoning either. Remember, many American brands like McDonald's have departed after its invasion of Ukraine. A Yale School of Management report originally dated January this year and since updated says some 1,000 companies have publicly announced that they were curtailing operations in Russia, and many of them have done so publicly, as we've been seen. Now back to India. India as a broad market, including for premium customers, continues to grow, though with some fits and starts. Some 100 million customers with strong purchasing power cannot be ignored by any brand anywhere in the world. Moreover, India has also evolved into a dependable manufacturing export base. Remember, companies like Maruti export 14% of their production. At about 280,000 cars last year, that's a large number. Other global car majors are also exporting from India, even as they sell into the domestic market. Ford is apparently looking at both the domestic and global market with renewed vigor and, I guess, fresh eyes. Many multinational pharma companies have pulled back from the domestic market in India, but they've expanded their R&D presence to serve their parent firms, and many manufacture generic drugs in India to export overseas. So Carrefour, which has about 14,000 stores in 40 countries, says it will launch in India next year. Carrefour and Ford have another thing in common. Both have come in or came in with joint venture partners that did not work out. They must have realized that there have been fairly successful foreign ventures in India in recent decades in their own sectors, including joint ventures. Remember, Walmart is in India, though not in the way people first thought they would, nor did Walmart itself. The company, of course, course-corrected to focus on e-commerce for Indian consumers and the India manufacturing base for exports. So there is a fairly obvious reason why some companies evolve and adapt faster to India and its multi-layer opportunities. And that is mostly to do with its people. The successful companies had the right ones driving it. And that brings us to our top stories and themes for the day. Markets fall again as global cues take hold. Oil price fall is now worrying markets everywhere. How rising temperatures and heavy rains are changing power demand patterns. The Bajaj Housing Finance IPO gets subscribed, but what is the future for non-bank housing finance companies? And London Heathrow is the most internationally connected airport in the world.
This is the Core Report with Govindraj Ethiraj.
Weakness on Wall Street grips Dalal Street. So a continuing weakness, at least for the last few days on Wall Street, has gripped Dalal Street once again on Wednesday as the market sold off. To take that occasional step back again, Indian markets are broadly in a direction-seeking mode as there are no clear upward signs visible, at least to me. There are no downward signs visible either, so which it means it's a good market for stock picking for those who want to. On Wednesday, the benchmark indices, the Sensex and Nifty, were both pulled down by global sentiments. The Sensex fell about 398 points to close at 81,523, while the NSE Nifty 50 fell 122 points to end at 24,918. Remember, this comes after 2 consecutive days of gains. Oil prices are falling. We are at a point where falling oil prices are now triggering concerns of a slowdown, the effects of which could even spread to Indian companies and thus stocks, as Morgan Stanley pointed out yesterday. On Wednesday, oil prices steadied somewhat after falling below $70 a barrel for the first time in more than 2 years, so it's around $70 now. Oil prices have fallen almost 20% on concerns of slowing growth in the United States and China. The Organization of Petroleum Exporting Countries Plus has already postponed an output hike. Bloomberg quoted the International Energy Agency, which will issue a revised monthly outlook later this week, saying in August that the market risked higher inventories next year, even if the cartel, that's OPEC, cancelled its output increase. Back home, stock prices of state-owned upstream oil companies like ONGC or Oil and Natural Gas Commission and Oil India fell almost 6% on the Bombay Stock Exchange. Shares of Oil India has fallen 26% from its record high of 767 it touched on August 30th, not too long ago, according to Business Standard. How heat waves and heavy rains are influencing power demand patterns. Peak power demand in India is estimated to have fallen to about 217 gigawatts in August compared to 238 gigawatts a year earlier, the second highest level recorded in fiscal 2024, a report from CRISIL Market Intelligence has said. Thanks to which the weighted average market clearing price in the real-time market fell about 45% to 3 rupees 30 paise per unit in August from 6 rupees per unit a year last year, that is. Demand has fallen across the country, with the western and northern regions experiencing on-year declines of 10 and 6%, says that report. Other areas are obviously also impacted. Now, coal and renewable energy production have fallen by 3 and 13% in the month. On the other hand, hydropower generation was up 7.6% after 2 consecutive months of decline, as many states, subsequently that is, received ample rainfall. While coal remains a key source of electricity generation in India, coal production has declined about 7.5% in August 2024 as the monsoon picked up pace. So what are these new trends and how does it influence the ability to predict demand and demand patterns in power? I spoke with Sehul Bhatt, Director of Research at CRISIL Market Intelligence and Analytics, and I began by asking him why we were seeing this dip in power demand since we usually expect consumption to keep rising.
So I think all temperature is the critical factor creating variation in power demand in recent times. To be specific, as per our observation, temperature in calendar year 23 was 0.65 degrees Celsius higher compared to long period average. And in fact, this year it has been even higher during the summer months. What it means is on account of increasing temperature, power demand obviously increases based on the geographical dispersion. Specifically at an India level, April and May, we have seen power demand increasing by 12%. However, in the recent months, thanks to healthy monsoon, power demand in India has seen a decline of almost 5.3% on year, which is close to 144 billion units, as the country received 7% excess rainfall during the month. Trend was very similar as far as peak power demand is also concerned. As per our estimates, peak power demand has declined to 217 gigawatt in August, compared to the 238 gigawatt we had seen last year, which was the second highest level recorded in the fiscal 24.
Got it. So you're saying that what we are seeing now is a reduction compared to the peak, which in turn was caused by high temperatures.
Right. And obviously the healthy monsoon has supported the overall demand scenario where because of lowering of temperature, the demand accordingly has also reduced.
In the last few years, we've also seen a rising trend in temperatures, right? So I'm just saying, what is the exact correlation between temperatures and demand, at least in the last 4 years, and if that's a one-way street?
So typically, if you look at in general the trend for power consumption, there are multiple factors, including the temperature, manufacturing pace, consumption pattern, and the obviously the penetration of consumer durable and so on and so forth. Obviously, there are correlation with regards to agricultural demand also. Typically, for the last 2 to 3 years, what has been changing is two patterns. One, we have seen that every year the temperature has been higher compared to the previous year as long as your long-term average or long period average is concerned, which is indicating that typically in the summer season, you end up having more consumption of power. Second, wherever the temperature has been higher even during the monsoon season because of lower monsoon period, and well, it was also supported by CNI related demand, you end up having peak season, which is not traditionally into the summertime. For example, previously we used to have peak demand only during the summertime. But we have also seen, the classic example is last year, we have also seen peak demand actually occurring in the month of August. So we believe that yes, temperature is a critical factor which determines the variation of power demand. But on top of that, the dynamics with regards to how the other factors also play out will take care of peak demand variation.
And what's the mix of power generation looking like, and how is that changing, Sehul?
So I think the generation has at least recently has mirrored demand trend where we have seen 3% increase in August. Closely, the coal and renewable energy production has contracted by 3 to 13% respectively. And if you look at the hydropower generation has surged by 7% on year after 2 consecutive months of decline as many states received sufficient rainfall. With southwest monsoon covering more part of the country in the August month, water level also across 31 reservoirs and hydroelectric projects have improved. So thus, I think the share of hydropower has improved from 13% previously to almost 15%. We also believe that despite increasing focus of RE sources, coal has remained a critical source of electricity generation in India. And in fact, the monsoon, as it picked up, coal production declined by 7% in August this year on YOY basis. And in order to ensure that we have uninterrupted generation amid surging temperature, the buildup of coal stock was required. I think we estimate that to be around 14 days of inventory, which we believe is healthy and sufficient stock thanks to steady dispatches that we have seen.
What's your outlook for the rest of the year, given that, okay, we've had heat waves, which was the first part of the year. We've had very heavy monsoons, which are still not over in this part of the year. And what's the rest of the year looking like?
So we project power demand to grow at close to 6.5 to 7.5% in this fiscal, owing to weather events, including severe and prolonged heat waves that were occurred in the first quarter, especially in the northern region, as well as insufficient rainfall that we saw in July, especially in the northern region again. Also supporting demand is a strong economic activity. On a long-term basis, we think that power demand will rise at a CAGR of 6 to 7% over the next 4 to 5 years, driven by factors including temperature increase, manufacturing pace, increasing consumer durable penetration, changing consumer and regional patterns. Now, keeping in mind the demand growth and the fact that non-fossil fuels having PLF lower than the traditional coal PLF, we think that the capacity addition is going to be slightly at a higher pace. We estimate that to be around 10% CAGR over the next 4 to 5 years.
Right. And finally, how is this all or likely to impact prices going forward, Sehul?
So typically the demand volatility, we have seen that impacting the prices, especially on the short-term market. Let me take a reference of June 2024, when power demand increased by around 8 to 9% YOY. And in line with that increase in demand, we also saw volumes which are traded in short-term market, especially on the RTM basis, which is the real-time market volume. The volume surged by close to 20%. That impacted the prices, especially in some of the north region, where in a couple of weeks for June, we saw prices going up to as high as 10 rupees per unit. However, last month, when we saw, obviously in sync with the demand decline that we have seen, weighted average market pricing for RTM has also declined close to by 45%. And they were hovering around 3.3 rupees per unit in August compared to 6 rupees they had. So we see that obviously with the demand moderating, decline that we have seen in case of August, prices have also fallen in terms of demand that comes up for short-term market.
Sehul, thank you so much for joining me.
Thank you.
Bajaj Housing Finance, is there space for another housing finance company? Earlier this week, Bajaj Housing Finance saw its public offer being oversubscribed, which was also largely expected. The company is a subsidiary of Bajaj Finance, and the IPO was largely also apparently triggered by regulatory requirements. Now, Bajaj Housing Finance is the second largest housing finance company. It has assets under management of about 97,000 crores as of June this year. The IPO is worth about 6,500 crores, and that included an offer for sale of about 3,000 crores. So the question I had was, what is the market like for housing finance companies that are not banks? Remember, HDFC was a finance company which merged into a bank, or HDFC Bank. So non-bank finance companies generally borrow at higher rates of interest and thus have to be more creative and innovative about the way they deploy their funds and where they do it, so that they can obviously charge higher rates and live happily. I spoke with Jignesh Shial, Director Research and Head of BFSI sector at InCred Capital, and I asked him how he was seeing the Bajaj Housing Finance company in the context of the larger market for housing finance.
So if you understand, look, housing, mortgage business in general in India, I mean, mortgages as a product, though, it has been quite popular for quite long period of time, still compared to most of the developed or even developing nations, we are quite underpenetrated. And obviously, being such a large populated country, the housing remains the need of an hour, and even government has been consistently focused on it and all. Being an underpenetrated demand specifically coming up from not only from metros and tier 1, but obviously from tier 2, tier 3, tier 4 cities and all. And definitely there is enough scope left for, couple of more or even a lot of lenders, including banks as well as NBFCs, to stay around. Specifically, banks versus NBFCs, I think, there are a set of customers who needs more prone towards, getting a service-oriented model, or those who wants more handhold to do the lending transactions altogether. I guess in that particular case, and specifically as you move more towards tier 2 cities and beyond, the NBFCs are having a quite a comfortable way of managing such kind of customers and, dealing with it and charging them a little higher compared to banks, and still, can do quite a lot of business into that particular geographies. So I think being underpenetrated and, more feet on the ground that NBFC has it, there is enough room for growth for, banks as well as NBFCs altogether.
Two questions. So, and that you're saying is despite what should be gap in the rate, the interest rates that are being offered by either NBFCs or banks, including public sector banks. The second is that what would be a number, Jignesh? For example, suppose you say India has 100 customers. How much would be, let's say, in these kind of markets, which is the relatively underserved, willing to pay higher interest rates versus those who are well served and are able to negotiate or hold a good rate?
So basically, if you see, the rate differential differs from, the client to client based on his financial data, his credit score, his overall how he has been behaving and all. The rate differential can be, 25, 50 bits to, even higher, as big as or as higher as 200, 250 bits also, depending upon what kind of customer or what kind of markets are you serving in. But if I see, still till date, if you see even existing data, if you will see it up, then I think major of the customer base, though there is no specific data or specific calculations that we have done, or even I guess it's available in the public domain. But I think if you will see static data or the existing data, major of the housing business or housing customers will be in the developed market, or basically in the developed cities, or basically tier 1 cities and metros and all, which is, little bit more cautious, little bit more concerned about the rates and all. But incremental demand, which is coming up, I think they are the portion of, this underserved, or where, you need a bit of a handholding, and those who want a bit of a more kind of a servicing, and still there, that they're ready to pay a higher rate of interest. Such kind of customer base will be, higher. So incremental side, I think those are the customers which are more into deeper into geographies and who wants, more of a specific servicing and all, and they're ready to pay a higher rate of interest. Those customers are quite higher compared to the static base if you'll see it overall.
Right. If I were to put the question a little differently, Jignesh, so the Reserve Bank of India has been tightening lending norms across the board for some time. And that obviously has affected, or I would think is affecting non-bank finance companies more than banks. Of course, in this case, a home loan is a secured asset, but at the same time, the environment is clearly not the same that it was maybe a year or two ago. How are you seeing this?
No, absolutely, yeah. Obviously, rates have increased, but that I guess is applicable to everybody, including non-banks. Even banks have seen a significant rise in their, the lending rates. The rates which were close to 7, probably 2 years or 2.5, 3 years ago, is almost inched up to 8.5 or 8.75 kind of a rate. And obviously for NBFC, it will be little will be even higher. But I think this is the rate hike is a phenomenon which has impacted banks as well as NBFCs in general, both kind of lenders altogether. And definitely the kind of customer profile they're serving up is also kind of little different. So in that particular case, it's been understood and it's been digested. Whatever customers you are servicing at this point of time. Obviously, the lenders among NBFCs, with the lenders with a more diversified borrowing profile. I mean, those who are banks, NCDs, deposits, all kind of mix. They are relatively better off compared to the ones who are were mono borrowers or a single line borrowers and all. But even in that particular case, considering that the rates have been inched up for both the kind of lenders, banks as well as NBFCs, there had been decent traction happening even for non-lenders as well, though cost of funds being higher.
Picking up on cost of funds, so NBFCs typically borrow from banks and obviously on lend and in the manner you just described because they're able to create better products, reach newer markets or less served markets. How do you see that source of funding evolving? I mean, do you see NBFCs continuing to depend more on banks or could they be able to raise funds from elsewhere and yet competitively?
Couple of, including Bajaj and all, they have been raising money more diversified manner compared to banks. The dependence on banks have been relatively lesser compared to a couple of smaller NBFCs and all. So there is diversity which is visible in the form of they raised money from capital markets, ECBs, deposits, and short-term money they're able to raise it. So there are diversity which is visible, and that's the reason I'm saying those NBFCs which has a relatively more diversified kind of a sourcing or kind of a borrowing. Their rates are more competitive compared to, a lender who has, or a borrower who has more of a banks. As the size of an NBFC grows up and balance sheet becomes relatively stronger, the ability to raise money from more diversified sources always had seen rise. So all the NBFCs, as they grow up their sizes, the dependence on banks really, starts reducing, and the ability to raise money through deposits or through capital markets and through ECBs and all has been rising. And even, I guess, RBI has been, consistently instructing NBFCs to diversify their overall borrowings and all. And I guess that has been visible since last couple of years.
Jignesh, thank you so much for joining me.
Sure. Thanks a lot for inviting me.
Samsung to downsize. Samsung Electronics is set to lay off some 200 executives across its Indian operations as it faces slowing business growth and mounting competition, according to a report by the Economic Times. The giant's decision to cut its managerial workforce by 9 to 10% comes apparently in response to declining consumer demand, particularly in its core smartphone business. And we've, of course, seen an announcement by Apple and its new iPhone 16. Samsung currently employs about 2,000 executives, and we'll return to this and its impact in a day. The mega hub airports and London. London Heathrow Airport remains the most internationally connected airport in the world this year and retains first place. LHR, as it's called, is the fourth biggest airport in the world in terms of scheduled one-way capacity in the year to August 2024, while British Airways remains the dominant airline at London Heathrow, operating 50% of all flights. All this comes from OAG flight data and is pulled from the 100 largest airports and the 100 largest international airports in the world based on total scheduled seats for the entire year, that's September 23 to August 24. Data is also extracted from the busiest day for global aviation in the past year, and the total number of all possible connections is calculated between inbound and outbound flights within a 6-hour window, if you're really wondering, and considering those where either inbound or outbound flights are international. By the way, Kuala Lumpur moves up to second place this year and is the most connected airport in Asia Pacific. Istanbul offers more destinations than any other mega hub. Frankfurt and Istanbul offer more than 300 destinations in their network. In North America, New York's John F. Kennedy International Airport lead U.S. airports, ranking 6th in the global top 50 list. Chicago O'Hare, that's ORD, and Atlanta, the world's busiest airport, move up the rankings. Chicago is 9th against Atlanta's 11th. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.